Hello everyone. I'm just going to take you through a few slides today, and we're going to look at what my group, part of Glasses, is AutoVista Group, and we look at data across Europe. So we'll be able to take you through some insights, both from the UK and from Europe. The things I'm going to touch on is really sort of what's happening in Europe, an idea of what's happening with Brexit. We'll look at some residual value forecast scenarios, and we'll look at the car market and LCV markets just to see what they're doing right now. In terms of some of the economic changes, across Western Europe, there's been a 40% drop in 2020 year-to-date car registrations. So it's really been significant. And the effect of COVID has gone on across most of the markets in terms of car registrations. If we look at what's happening across Europe in terms of GDP forecasts, and we've taken Moody's in this case, and globally, the GDP estimate is down around 4.8%. In the Eurozone, down around 7.3%, but in the UK, it is worse, and around 8.3% according to Moody's, and that's worse than even in May 2020. There are more negative outlooks as well, and these in the UK can be up to around 13% down on GDP. So it's not a great forecast moving forward. So what do we think is going to happen over the next few months? Well, we know the sequence of events that's happened over sort of the last 15 or 20 weeks or so since March. Overall, this has really affected new car sales and used car sales. And for the year, we're looking at the year being down around 30% for both of them. Logistics is still causing issues because getting cars and vans into the market is still causing issues, so that registrations are down, and also used car movements for wholesale and for retail is quite a lot more difficult than usual. If we see further reductions in the pound-euro exchange rate, then we will see increasing costs, particularly for new cars, as most of our supply comes from European factories. And if the UK does suffer an even deeper recession, another forecasted down 11.5% according to the BBC this morning, we will see significant falls in what's happening in customer confidence, I think. And remember, nearly 9 million people, around a third of the workforce, are still relying on the state to pay all or at least part of their salary at huge cost to the government. So what we've been doing is doing quite a lot of scenario planning. And our highest probability risk is that we'll see a deep recession and quite a slow recovery. However, as we move towards the end of this year and the end of the furlough scheme, the likelihood of an even worse recession is a possibility. So we are keeping our eyes on that to see how the end of the furlough scheme really affects what's happening in the UK. On top of COVID, there is the Brexit impact. Now, officials agree they need to agree some kind of terms by the end of the year. However, progress is really slow at the moment. And the transitional arrangements that we're currently going through expire at the end of this year. Now, looking at the way businesses have reacted to COVID, they're unlikely to be able to react to another big shock. They've already borrowed huge amounts of money under the coronavirus relief programs. And again, if we look at the euro exchange rate, this could become a real issue if the euro comes to parity with the pound, which would make all imports significantly more expensive. Now, if we look at our residual value forecasts, now for this year, we're reasonably positive. And this is mainly around the supply of used cars in the market and this current demand. There was pent-up demand in June. We saw a real spike in demand. And we're forecasting that July will be similar, particularly because the Scottish, the Irish and Welsh dealers didn't open till late in June. So we'll see some real positives there, both for new and used car sales. However, next year, with the impact of both Brexit and the final bits of furlough running out, we'll see a decrease, not as steep as some of our competitors are looking at, but we still think it's going to be quite significant. So down about 3.6% versus March this year. And then when we move into 2022, and we've got used to the trade implications of Brexit, we're overcoming the biggest issues, not all of the issues, but the biggest issues of the coronavirus pandemic, we'll see some recovery up to similar levels that we've got this year. Now let's just look at the market realities. So we follow the market on every month on a regular basis, looking at wholesale and retail for both LCVs and cars. So just looking at private demand in the car market has been relatively strong, especially in June. It was only down 19.2%, so real positives there. However, in the fleet and business segments, watch sales channels, it's been relatively weak and it hasn't come back. And this is predominantly down to businesses pausing spending. I think most businesses have looked at their budgets. There are issues in terms of getting money in, and they want to slow money going out of businesses. And fleet sales particularly are down. So they're down 45.2% in June to just 69,500 units. So some real issues. And even year to date, we're not really recovering. So really down around, well, on average, 48.5% across the market, like we said before. So some big issues to overcome there as we move forward. If we look at the way the market's reacted year to date, so this is just total registrations. But looking forward, June was meant to be a real spike in demand, but we didn't see it. And some of that is down to only the English dealers being open right from the start of June. Now, hopefully in July, we'll see a bit of further recovery, but we're still down half year, down 48.5% at just 653,682 units. Some real catching up to do there. And like I said before, particularly for the car market and for the LCV, we're likely to see recovery just back to about 30% down year on year. For the LCVs, it's following a very, very similar trend. So down April, down 86.2%. May 74.1%, and then starting to come back in June, down 24.8% year on year, but we're still left at a year to date figure for H1 at 44.3% down and at just 108,876 units. For the wholesale market, so here we're talking about the auction side of the business predominantly. So effectively, they've mirrored the new car market and new LCV market. June's auction sales were smaller than usual, but there have been significant increases in volume and conversion rates versus May. So buyers are starting to get used to buying predominantly online. Although physical auctions were able to open in June, very few have actually opened up again. And so online is the most likely route to market now for most wholesale sales. So here we're talking about vans and cars, and volumes are continuing to grow. And again, first-time conversion rates, which is an important figure, have grown significantly and actually overachieving what we were doing a year ago for both cars and vans. So quite a positive picture there for the wholesale market. If we look at just volumes here for cars, we can see how the volume dipped off completely in March and April, just down to the lockdown. Sales didn't really start going again until the middle of April, when we could see quite a few online sales just coming on and testing the market, getting used to describing those vehicles in slightly different ways, making sure images were right, so that the trust of buyers, and that's the important key here for the wholesale business, that we can gain the trust of buyers so they can start coming back to auctions and buying online. It would appear that certainly moving forward for the foreseeable future, the majority of sales will stay online. In terms of percentage of cost new, this is quite an interesting chart, really for 0 to 3-year-old cars, so the fleet profile cars. So the line here that represents the electric percentage of cost new has been in a torrid time really since June last year, but it's actually coming back to follow the rest of the market. Now that's important because remember, the battery electric vehicles predominantly are more expensive than their internal combustion engine counterparts. So coming back to a similar percentage of cost new is really, really important. But what you can see is that the market here, particularly for these young used cars, relatively young used cars, is starting to dip down slightly. The more positive part of the market, where prices are starting to rise, is where the supply is at probably its lowest ebb, and they're the cars that are predominantly the part exchange cars that come into dealerships, and they tend to be slightly older, so maybe 5 to 8 years old. And those cars are really in short supply right now because new cars haven't been sold, so the demand for those has increased. Hence, the prices of those are starting to go up a little bit. In terms of next steps, now, people have asked me quite a lot over the last few weeks how we look at data and how data can really help you develop in the market. Now, what we've got available are a number of things, but we use our residual value intelligence across Europe to just monitor where prices are across Europe. And this chart is very simple. It's just a market price index of where we were at the beginning of February to where we are today. And we can see the red line is actually the UK line. And overall, in retail, the price index here in the UK is very positive. And this is available for a free demo if you should wish. But we also have a look at what's happening in COVID across Europe that's available as a free download. Now, this presentation will be available online, so you'll be able to follow the links if you'd like to download that. Thanks very much, and I'll pass back to Fran.
That's great. Thanks, Anthony. So would you say that kind of residual values are recovering well at the moment?
Yes, it's very, very positive at the moment, both in wholesale and retail. We're seeing that prices have really recovered. So way back to, if you look back to February, they're on about the same level in terms of wholesale pricing, and actually retail is starting to creep up significantly particularly for this time of year. Usually we'd see a seasonal fall in June, July, August as things start to slow up a little, but no, this year is very positive and we are starting to beat the year-on-year figures.
And do you think, so obviously there's a lot of talk about being in a restart or kind of in a recovery mode. Do you think we are at that now? And do you think we'll expect to return to normal soon?
Well, it's certainly in the news this morning. A number of MPs are pushing to suggest that we've been victorious over the coronavirus. I think we've got to be careful. The likelihood of another wave in the latter half of the year is a distinct possibility. I think right now, for the car market, it's make use of the data that's out there. Look at the way things are selling. Look at how we can price, or how you can price those cars and the end of life cars. So if you're remarketing those cars, make sure that you price those sensibly. It's not a point. So some forecasts were suggesting that everything was going to be so much cheaper, but asset values were falling significantly. But right now, what we're seeing is real positivity in the market, and we are getting towards the end of hopefully the worst of the virus.
That's good. And obviously, any kind of recession and economic crisis can shake up businesses. I think we have seen that with quite a number of, obviously, dealerships choosing to close. Do you think there'll be a fundamental shift in the way dealerships will have to run in the future?
I think that there's a distinct possibility that more will be more business will tend to go online. Customers will be doing even more research online before they step over the door threshold. They'll be looking at how they can find the best deals for them, but also the best finance deals. It's not just about finding the best car these days. It's finding how can they make the best value for money for them. Now, right now, we're seeing businesses closing. You're right. So consumer confidence is relatively high for the amount of people that are being made redundant. If that continues, we will see a downturn. So we've just got to be careful how we go through the rest of this year and into next, how we position the vehicles that are coming off fleet, but also how dealers can actually sell those to customers. And online is probably the way to go, because it's so much easier. You can do most of the research at home. It's just that final look at that car. And we've always got to remember, particularly in the used car market, that every car is unique. It's got so much miles, it's got a little bit of damage, even if it is just a few paint scratches. So around describing that vehicle accurately, first of all, what did it leave the factory with? But then secondary, how damaged is it? How far has it gone? What is its service history? When was its last MOT? All those kinds of things become even more important through the online portals, because customers expect to be able to do their complete research now online.
That's great. Thank you very much for your time, Anthony. That's really insightful and interesting.
You're welcome. Thanks, Fran.